an assessing officer can invoke the disallowance. The proviso is important. Provided no disallowance on account of any expenditure being excessive or unreasonable. So which is a clause A of 48.2, right? Excessive or unreasonable test. No disallowance on account of any expenditure being excessive or unreasonable. Provided that no disallowance shall be made, having regard to the fair market value shall be made in respect of specified domestic transaction referred to in 92BA if such transaction is at arm's length price. So if you satisfy the arm's length test under 92F, then your 48.2 disallowance vis-a-vis the first aspect at least gets addressed. So the point that I am trying to put forward here is the interplay between 48.2 and your 92BA. If you satisfy the arm's length test under 92BA, 48.2B, the same arm's length price will be treated as a fair value, and you are saved from 48.2B. Having said that, even if specified domestic TP is not invoked, assessing officer could still invoke 48.2B, either on account of the first bullet or on the second point, which is legitimate needs of the business. What if assessing officer concludes that this expenditure is not for the legitimate needs? That is possible. So that's the point that I was trying to say, that SDT and 48.2 be interplay between these two sections. Any questions on this point so far? 92BA and
just to cover transactions less than 5 crores. Otherwise, once you say everything is at arm's length, it's already covered.
My take is perhaps no, because you may be still at arm's length, but what if the assessing officer comes to the conclusion that the payment is not according to the legitimate needs of the business or profession? There are 3 different clauses in 48.2.
Is the second claim the proviso a part of 48.2 only?
True, but it starts with no disallowance on account of expenditure being excessive or unreasonable. So it only refers to part A of 48.2 and not B and C. So there is a scope for the assessing officer to still invoke 48.2B is what I'm just, as I said, these are honestly, some of these discussions could be academic, but we as professionals should at least try and get the basics right. So that's why I'm sharing it with you.
In fact, I would believe that would not be about academic, because in several cases of international transfer pricing also there have been instances where the TPO says it's at arm's length and then the AO tries to disallow under section 37.
Right. That's
So that is
very well said, and a couple of other situations also we will see where even if 48.2 doesn't apply, 48.2 disallowance doesn't apply, you still have to meet the domestic TP test.
But here excessive or unreasonable also is considered with regard to all these business needs as well as other factors.
That's the interpretation debate, isn't it? That should you apply excessive unreasonable to all 3, or should you read 3 independently?
So I think it is for all.
Okay, appreciate. So that's
What is, suppose instead of one office to take entire building on rent, that is not legitimate doing test passing. Another example could be reimbursement of educational expenses of the director's son, which would be at the fair price,
right.
but which may not be the legitimate needs of the business.
Perhaps, unless it is contractually covered. Yeah. So his example is, I don't know if everybody would heard what he said, is that you could be reimbursing school expenditure of director's son, and that expenditure may be at fair value, but whether it is legitimate having regard to the business is a matter which is needs a subjective determination. So thanks for that example. Coming back to again the domestic TP, so you have 92BA which says that the payment should be, the expenditure should be in respect of payment to be made to persons covered under 48.2. We have seen this list for years and years and years. The list of related parties that are covered. Should I go through all these lists once again, or should I just focus on the key change that has happened last year? Key change. Yeah.
How do you interpret these 2 words in 48.2b? Honorary
and excessive? Are they synonymous? Are they different? What are they? Excessive can
Right.
be unreasonable, but unreasonable cannot always be an excessive also.
True. I think you need to read both the words harmoniously together, it's very difficult to say yes or no type of answer. And as I said, we have seen that many times the payments to directors' relatives have got questioned. So you demonstrate with the experience and so on and so forth, even in the normal assessments.
So the word unreasonable can also be related to the legitimate needs of the business.
Right. So you're sort of supplementing the arguments that our friend over there suggested, that you should apply to all the three clauses. I would believe so, that's what the argument is, but there are, if you read some of the commentaries on domestic TP, this view has been put forward, and of course it will come up for testing in due course as the law evolves. So persons covered under section 40A2, we have company directors, their relatives, HUF members, AOP members, partnership, their relatives. You look at, in case of companies, you look at the directors and their relatives as well. One specific point, so these relations you are very well aware about, right? So I will proceed based on this assumption that all these parties which are covered under 40A2 are the parties which are well known. I mean, that we've seen it over the years. I will straight jump to one specific case. I'll then come back to other aspects around it. What is the beneficial ownership? We have seen beneficial ownership is to be tested for the shareholding, and 20% is the threshold. In case of company, 20% equity. In case of partnerships and others, it's a profit power to derive 20% or more profits. In case of companies, there are two specific situations. Let us take this kind of a structure. A holds, let's say, 50% in X and 50% in Y, and there is a specified domestic transaction. Let's say X has made a payment to Y. Okay? Whether this transaction will be, whether party X and party Y, will they be treated as a party covered under 40A2B? That's the question. Before Finance Act 2012, transactions between X and Y were not included in the definition of 40A2B related parties. So these transactions were out of 40A2 disclosures and compliance. But along with the specified domestic transaction introduction, they made one change in 40A2B. Is this transaction between X and Y is also covered. So basically, transaction with a fellow subsidiary is a transaction which is to which domestic TP is applicable. Mind you, this also has a consequence on your tax audit disclosure. So that is independent of domestic TP. Yes.
But in a situation where suppose A is holding 60% in X and holding 30% in Y.
It would still be covered because it uses the word substantial interest. So,
but 60 of X. So if you count 60 to 30, it is 18%.
right. So you don't look at the effective holding. Anyway, there is no effective holding between X and Y. A is holding 60% in X. A is holding independently 30% in Y.
Yes.
So A is able to de facto control substantial interest in both the entities independently, because the substantial interest threshold is 20% as far as 40A2 is concerned.
That's the reason I am saying 18%.
No, it is not 18% because yeah. So if it is a second scenario, we'll come to the second scenario. I am on the left side box right now.
So he's sitting on the right hand corner.
Right. So transaction between X and Y will be subject to domestic TP, and as I said, 48(2)B tax audit disclosure will also be therefore relevant. Now let's come to the second figure, the second diagram.
Right.
A holds, let's take 60% in X and X holds 60% in Y. The question is, and let's say Y makes a payment to A. The question is this transaction is a transaction which is between the entities which are covered under 48(2), and therefore whether domestic TP applies. So question is direct holding versus indirect holding.
Indirect is not.
Right, so the way section 48(2)(b) is worded, it talks about a company holding substantial interest in another company. If you look at A, X and Y, A is holding substantial interest in X. X is holding substantial interest in Y. So therefore indirectly for company law purpose and other purposes, A is holding substantial interest. But the way the substantial interest, at least in the tax context and in the 48(2)(b) context, has been interpreted, you should look at the direct immediate shareholding. Similar issues or situations that we come across are in the context of section 79, carry forward of losses. If there is a change in the shareholding, should you look at a direct immediate shareholding or should you look at the eventual shareholder? And there the view that has been settled is that you look at the immediate shareholder and not look at the eventual shareholding. Same issue came up even in the Vodafone judgment, though in a different context, but it also sort of upheld the same principle. So you had an amendment subsequently in a different context, but the implicit point on direct shareholding has been seems to be well settled. And I must give a credit to the Institute of Chartered Accountants of India to sort of come out with such explicit terms. The revised guidance note issued by ICAI last year in August 2013, there is a specific discussion on this aspect, and they have very clearly said that transaction between Y and A is not covered under 48(2), so you don't need to disclose it for the purpose of tax audit for sure, but this is guidance note on TP. They have said that these transactions will also not be subject to domestic TP compliance. They have analyzed a 1968 circular, they have analyzed various judgments and have given a view. So at least as members we can, if we are taking that view, we can very well give a reference to this guidance note in the notes to the tax audit report or to the 3CB that we prepare for the clients.
But if X is a paper company without having any substance, so the same position is going to.
For specified domestic TP purposes, yes. Unless you have a GAR situation where assessing officer disregards entity X, but just for domestic TP and 48(2) applicability, I think you will not be able to disregard the entity for the TP compliance purpose. I mean, courts can perhaps do it if they come to a conclusion that it was all sham. But I feel from the context of domestic TP, I think in at least 90% of the situations, this clarification will help.
But this is not beneficiary holding the share.
Right.
So beneficiary still means that it has, I mean, if it is a share company, then obviously beneficial holding is with A and not X.
Right, but you are disregarding the corporate structure. That's what I'm saying, which is a company, which is a separate legal entity, you are disregarding it.
So, but on paper it is very clear that there is no substance, just investment company.
So I would differ with you. If it is an investment company and on paper, that doesn't mean it is a company without substance. You could have an investment company on paper with substance as well. But anyway, that's a separate debate. The point is valid that what if eventually court says that X is you disregard X completely, and then whether penal consequences of not doing domestic TP will apply or not, those situations could arise. I don't disagree with you on that. I'm saying the law as it is today, and let us assume for the moment that all these entities are with substance, then domestic TP is not applicable. Another point is that, as I said, this substantial interest threshold is 20%. Whether this 20% is to be in case of specifically directors, if let's say you have multiple directors, each director holding below 20%, but collectively they hold more than 20% influence, whether they can be said to be having influence over the entity, and therefore whether domestic TP is applicable or not. Any view on this from any one of you? Whether you should look at individual director holding or whether you should look at multiple director holding. Let me just elaborate this a bit. Let's say you have X and Y. Forget A. You have three individuals who are directors on X and who are directors on Y. Each individual holds 10% in company X and Y. So both the directors, all three directors collectively are holding 30% in both X and Y. So would X and Y be entities for the purpose of 48.2?
But are they relatives of each
Not
other?
unless they are relatives.
Does it matter, relatives?
Maybe.
Okay. So they are not related to each other. You are right. If they are related, then you have to aggregate. If they are not related, yeah. So I agree with you that if they are not related, then such situation will be out of domestic TP.
If it is related,
Then you need to aggregate the holding because the
but
way
if the
section.
father and son is holding,
Right.
okay, together 10% or 15%, okay, in both the companies.
You will have to then it may get classified under 48.2 and therefore SDT will become applicable.
So it uses the word any or no. So it means individual which we have to consider, not aggregate.
There is no word aggregate.
So in section 48 to
The way it is worded is that I am reading clause 4 in 40A to B. It's a very longish clause. I will skip few parts when I am reading it. A company having substantial interest in the business or profession of the assessee or any director or member of any director of such company or any relative of such director, partner or member, and therefore in case of father-son situation you have a director whose father and his relative.
No, but individually they are holding 15%.
I agree. It says that, so again I am reading that clause, in case of a company having substantial interest in the business of the assessee or any director or any relative of such director, if they control substantial interest.
So independent.
Physically.
Okay, so I would read is in this case director or his relative, if they are exercising substantial interest, then you may get covered. But a director and another director is not envisaged in this clause. Maybe we can offline discuss on this point. We can go through the section once again. But this is the interpretation that I would put to 48.2.
So aggregate value of all relative is 20%. If it is more than 20%, then it will be bigger.
Right. Within relatives. Director and his relatives. So moving on, we saw 48.2 and the different limbs of it. So specified domestic transaction. Let us look at the key differences vis-a-vis a domestic transaction and an international transaction. We saw in the earlier sessions what is the definition of international transaction. International transaction means a transaction between two or more associated enterprises, and at least one of the two associated enterprises should be a non-resident. That is what we saw. That is what we saw as a definition of international transaction, which triggers the international transfer pricing. Domestic transfer pricing, any payment to party covered under section 48 to B, etc., etc. So what are the key differences? In case of international transaction, international TP, both income as well as expenditure side is covered. Under domestic TP, as far as 40A2 is concerned, it's only the expenditure side is covered. You don't test the revenue side. You test the revenue side only in case where you are eligible for tax holiday under 10AA or 80IA 8 or 10. So this is one fundamental difference between the two, that only in case of tax holiday entities revenue side is tested, not otherwise. Second aspect, and which is extremely critical, especially in the situation that you mentioned, for the international transaction, we studied the definition of associated enterprises, and there are different relationships that have been given. As far as the holding between the two entities is concerned, the threshold is 26%. Only then the two entities become associated enterprises. Whereas in case of 40A2, we have a situation where the threshold is 20%, right? So, so this is one important difference. As far as 80IA 8 and 10 is concerned, there is no equity percentage that has been specified. All it says 80IA 8, as you would recollect, it says close connection. 80IA 10, sorry, 80IA 8 is within your unit, so there is no question of shareholding. 80IA 10 says that close connection. So the entity may not even have any shareholding or cross-holding, but still domestic TP could be applicable. As far as 40A2 is concerned, meaning the expenditure in a normal situation is concerned, you have a substantial interest threshold of 20%, unlike in international transaction, which is 26%. And let me deal with a case study right here, since we are on this point. It's on the next slide. Let us say you have an entity A, which is an Indian company. Entity B is holding 23% in entity A or company A. Entity A is purchasing or importing certain goods from entity B. Is this transaction, so here entity B is a non-resident entity, it's not a domestic entity, it's a non-resident entity. Do you think the international TP will apply, or domestic TP will apply, or nothing applies?
General versus
nothing applies. Those who feel yes can raise their hand. Nothing applies on this transaction. No TP applies. Domestic TP applies. How many of you believe domestic TP applies? So just 3 of you. And international TP, will this transaction be subject to international TP? Okay. Let me take you to 92BA. For the purpose of this section, following transactions not being an international transaction. So first test that we have to satisfy, is this an international transaction? We studied that international transaction is transaction between two associated enterprises, and definition of associated enterprise gives a threshold of 26%. So if I am below 26%, I am not an associated enterprise, which means that the transaction is not an international transaction, right? So not being an international transaction test is satisfied, so that third scenario is out. Moving on, following transaction, any expenditure in respect of which payment has been made or is to be made to persons referred to in 40A to B. 40A to B tells me that I should look at 20% substantial interest. Let me come back to the case study. Entity B is having 20% or more substantial interest in entity A. So as far as entity A is concerned, it is an expenditure because they have purchased the goods, imported goods from entity B. So this transaction will get covered under domestic transfer pricing. So the key takeaway is that while we say domestic TP, you could even have cross-border situations wherein domestic TP could be applied as well. I have one more interesting case study which will sort of make this point clear. It's slightly complicated, in a permanent establishment situation. Let's take a situation, you have an entity A, which is a foreign company. Entity A has a branch in India, which we in normal situations call it as a permanent establishment, right? So entity A is having branch in India. One of the directors of entity A, to whom entity A is making salary payments and other payments, is deputed to this branch in India. Branch, as you all know, for income tax purpose is a non-resident. Branch is able to claim the deduction for the expenses which are attributable to branch's activities in India. So this director's salary is attributable to the Indian branch or Indian permanent establishment that company A has. Let's take a situation that this director is a non-resident person, so he is maybe operating from outside and only visiting India for the business purpose, etc., and he's being able to manage. So he is a non-resident essentially. So here you have a situation where entity A is making a director's remuneration payment to Mr. A, who is a non-resident. So it's a transaction between two non-residents. But the director's remuneration is charged to the permanent establishment in India or branch in India. When you are computing profits of Indian branch, 48(2)(b is applicable. And here there is no question, perhaps there is no associated, let's for the moment assume that this is not an associated enterprise situation because of the, if that is the situation, you could potentially have a domestic TP also applicable for the transaction between two non-residents. So the key takeaway is that please test the relationships carefully and don't assume that domestic TP applies only if there are two Indian entities that are involved. So this is one key difference which is there. International transaction, you have benefit of unilateral as well as bilateral APA. Safe harbor provisions are also provided for and are available for the international transaction. In case of specified domestic transaction, at least as of now, there is no unilateral APA, nor there is a safe harbor that is available. But I'm sure once this litigation grows, department will consider one day safe harbor for domestic TP as well. One key point is this deemed transaction concept, which was introduced in the International Transfer Pricing by Finance Act 2012. That is applicable for international transaction. It's not applicable in case of specified domestic transaction. And we'll talk about few instances of this a little later. So any questions on SDT definition under 92BA, 48(2)(b? Any issues, any experiences that you have on this point before we move on?
The argument of SDT applying to cross-border transactions also, a plain reading of 92BA, yes, there is no mention of the residential status of the parties involved, and therefore 92BA could apply to cross-border transactions, but then it defeats the purpose why SDT was involved. And I could always go back to the memorandum of explanation which says that it has to apply to residents as an assessee.
Sure. So if you look at the intent, perhaps yes, but finally you need to look at the provisions of the law, and unless there is some miscarriage of justice, I would say there is no reason why.
It does amount to miscarriage of justice.
Why? I mean, all
that escapes international transaction is again brought into the net of transfer pricing.
No, I will put it the other way. See, you have 48(2) was always applicable or is always applicable, right? There is no denying on that. What I'm saying, I'm just giving a counter to your view. 48 is always applicable. If you look at memorandum, what memorandum tells us is that domestic TP is giving you a method to madness, which is way to determine the fair value, which you anyway, assessing officer was well within his right to determine under 48(2). What if in a case study that we saw, here assessing officer comes to conclusion that the imports are at a higher price, right? So in my view, I think this argument probably will not be sustainable, at least in this kind of a situation.